Hi guys, thanks for tuning in to another episode of Nugget News, or our monthly housing and economy update with our friend Martin North. How are you, Martin?
Pretty good, Alex. How are you going?
I'm a little bit tired. I stayed up and watched most of the cricket last night, which was great, but we've got plenty to get through today.
Yeah, I suspect that the numbers in the cricket are going to be better than the numbers here.
I think so. So there's a lot been happening. I think the general talk in the media is about the strong housing recovery, a lot stronger and sharper than we would have expected as well. And I'm sure we'll dig into that and why that's maybe not a good thing.
Yeah, I think there's a lot of hype around it, but yeah, there is some data that's pointing to more positivity in some areas, but you have to set it in the broader context, right? So I think of the conversation around economics on like a seesaw, right? There's stuff going on the upside and stuff going on the downside, and it's a question of how those two things adjust over time. And when you actually then put them together, you think, well, where are we on that swing, right? And I suspect there's a lot of downside as well as upside. So
Absolutely, and I'm sure we'll get into all that as we get into these slides. So, first up today, sorry, I've started down the bottom today. So, first up, we've got GDP coming in pretty weak. Trend is 0.4, but I think the official number was 0.5. Is that right?
it depends whether you go seasonally adjusted or trend. I use trend because it sort of irons out some of the humps and bumps.
Yeah.
And yeah, in fact, the number was a lot stronger than a lot of people. A lot of people were expecting a negative quarter, right? But we were saved, and we'll talk about what we were saved by shortly. But essentially, the whole point about this is, one, GDP is very low, and you can argue whether GDP is a good measure or bad measure of what's going on in the economy. Many will argue, I argue, it's a bad measure because it measures throughput rather than quality or other things. But anyway, that's the one that economists look at. But within that, if you look at the distribution, what you can see there basically is we were saved by the exports, which were pretty strong, and we were saved by government spending.
Yeah.
But both business and households are very negative. And frankly, I'm not sure that exports will continue to support us ahead because, of course, it all to do with the iron ore price, which we'll come on to. So, yeah, this is a very concerning thing. This is the lowest level in the economy that we've had for a long, long time. And the problem that I see is I'm not sure what we're going to do to see it turn around. Now, some of the economists are arguing, well, of course, we've got this household, these tax credits, and we've got lower interest rates. So that should encourage households to spend more. And I'm not sure that's necessarily the full story, as we'll get onto in a second.
Yeah, I think I read that this is the most that the government's been responsible for in terms of GDP. We would be in recession if it wasn't for them, and at the same time, they're spending record amounts, and they've signalled that they're not willing to spend more.
Yeah, that's right. So the government is absolutely fixated on a surplus, and that means that they're going to not put more into the economy at this stage. And it's interesting that Philip Lowe, the RBA governor, basically said, look, there's a limit to what monetary policy can do. The government does need to do more. I rather subscribe to that view myself, but they got stuck with this political problem, which is that they're going to stick to a surplus, which means there's a limit to what they want to do.
Absolutely. So next up here, we've got household finances. People continuing to dig into their savings, Martin.
Yeah, so this is a worrying set of trends. So, again, from the accounts, the first is household savings ratio drops again. So in trend terms, it's now down to 2.6. And what that basically means is this is back close to, GDP, GFC levels, right? So households are dipping into their savings. And there was an argument spun a few months ago by the Treasurer that this is a sign of confidence amongst households. In other words, they're happy to raise their savings, but they're not doing that because they can actually feel confident. They're doing it because they have to, because the income is just not being supporting their lifestyles. And that goes through to the other side. So the average compensation per employee is very, very low. It's 0.6 in trend terms. And the other interesting factor is if you look at it on a disposable income basis, in other words, after tax take has gone up. So in fact, it was negative 0.3% in the quarter. So in other words, households' real true incomes are going backwards even now. And of course, all the research has shown that in real terms, there's been no growth in average household income since 2009. So this is a long-term problem that we've got. And this explains to me why we've got all the issues we have in the housing sector and in the household sector, insofar that households are not getting any income growth.
Yeah, and I reached out to Steve Keane, Roger Montgomery, a few other friends of the channel, because I want to keep talking about the fact that around the world, we're starting to see evidence that when central banks drop interest rates, people actually save more, even though it's meant to encourage them to spend, because these retirees, they're very dependent on earning that interest. And with the savings dwindling at a time when people are actually trying to save more as well, it's a double negative, really.
Well, that's right. And, you look across the different segments as we do. There are 3 million households who are totally reliant or partly reliant on income from term deposits in the banks, right? Yeah. And those rates are going lower and lower and lower. In fact, the way that the banks have been able to balance their net margins, because they've been cutting mortgage rates too, is to take deposit rates even lower. And my surveys say that most people with term deposits are not going to give up on term deposits and start spending, because they see that as a critical part of their long-term wealth strategy. What they're going to do is skinny back on their spending. So, yeah, that's the part of the equation that not many economists want to talk about, because everyone's worried about loans and mortgages. But this is a really critical issue. And 3 million households in Australia will spend less because they're having less coming through from those term deposits.
Yeah, banks are robbing Peter to pay Paul, but they're actually taking more off Peter than they're giving to Paul. They're sort of, it's just crazy how this all works, isn't it?
Well, it just compresses the total momentum, and that explains a lot of why we're seeing households. And the next slide is about household confidence, right? And we measure this on a segmented basis. This is the aggregate number, so it's low again. It's as low now. We're in regions we've never seen before, even back in 2015 when it was pretty low then. And there's a little bit of an upside in terms of property prices, and that's come through with a little bit more positivity around net worth if you've got property. But as I said, that's offset with this 3 million households who are actually reliant on savings. Also, people are quite twitchy now about the stock market because the volatility going up, going down. Is it going up? Is it going down? People are now thinking, well, I'm not sure what's going on here as well. And then we've still got this issue of cost of living rising way faster than incomes. The CPI just doesn't, as we've talked about several times, doesn't cut the mustard in terms of real lived experience of households. So many costs are going up. The one I'm watching now is fuel costs, right? So as the exchange rate moves around, we see that the price at the bowser goes up. And that's another very big impact on households directly and second order through to other transport sectors and all those things. So, yeah, overall confidence not going the right way at the moment.
Yeah, it's a little bit subjective, but I do like this one because I know through the media they're really trying to push that narrative that the bottom's in, and I'm getting so many ads watching the cricket about how now's a good time to buy property and all that kind of thing. So I'm interested to see how that confidence plays out, and particularly in the US and the stock market and the trade wars. Now that Trump's got his meeting, if the stock market doesn't make a new high, people are going to say, well, hold on, I thought everything was fixed. What's going on?
Well, that's right. And remember that all of the strategies around the world, lower interest rates, quantitative easing, is to inflate asset bubbles, right? So you would expect the stock market and you would expect house prices to be on the upside as they continue to do QE and as they continue to cut rates. The difficulty is that it's illusory, right? Those are not real increases in wealth. It is completely illusionary, created by the central banks doing what they're doing. And if you look at Japan, who's been at this longer than almost anybody else, it's no solution, right? So effectively, no one has actually figured out from a central bank perspective how to deal with what we're dealing. We're just going around the old rinse cycle again. And so we may get some asset inflation, but it doesn't actually fundamentally address the economic issues that we face, not just in Australia, but around the world.
Yeah, I think a good example, I read about this the other day, was Apple. They haven't grown their earnings in 4 or 5 years now, but because they've bought back so many shares with all that money that they've got, earnings per share looks really good on paper. And I actually think the stock market will make new highs if central banks aggressively cut rates. So it's all this game of business not actually getting any better. It's what a central bank's going to do.
Yeah, no, that you're absolutely right. So we know that in the US and indeed even here now, companies are borrowing really low rates and are buying back shares, which means that this investors see their values rising. But it's not creating real value, right? And there is a lot of talk now about what we call zombie firms. So basically firms that are really not creating more value, what they're doing is manipulating their share price by buyback schemes. That can go on for so long. But of course, it doesn't create real value in the economy. And that's the problem that we've got. We've got effectively the central banks worried about financial stability and trying to actually support the financial markets and the stock markets. but it's not translating into real outcomes for real people. And that's the thing that I'm most concerned about.
I had to laugh the other day, Martin, when Josh Frydenberg came out and told big corporations that they need to give back more to the people. And then I think the following day, Harvey Norman came out and said they're going to have to raise more capital so they can keep paying fatter dividends. Oh.
Yeah. Yeah, I mean, it's like Alice in Wonderland, right? So there's a parallel universe out there where the 1% are doing very well, where the central banks are supporting the financial markets, and people are confident that if the banks get into trouble, they get bailed out one way or the other. But in the real world, in real households, it's a very different story. And just locally here down in Thirroul, where I am, there are 2 shops shutting now, been around for years, that they just can't survive because people aren't spending. And it's that real economy that I'm worried about. There's such a gap between the reality of lived experience for real people and what everybody at central bank land and in government land are talking about.
Yeah, we've seen a number of Woolworths close. I know down here in Tasmania, one of our number 1 seafood shops in the middle of town is just shut up shop. Like, I would have never thought that would happen. But we better get on to the next slide, Martin, or we could talk about this all day. But mortgage stress is still at those record highs.
Yeah, it actually didn't go up very much at all this last month. And that's because we had the slight relief from the 2 interest rate cuts and the tax credits that people are getting. So it went sideways, but it's still at a record high, more than 1 million households struggling with those mortgage repayments. But what I'm concerned about is the mix. What we're seeing is more households now in New South Wales and Victoria being exposed to significantly higher stress levels. And if you think Mandurah over in the West was a leading indicator 2 years ago, and you could see what happened there, I'm seeing the same trends now in some of the other postcodes down the East Coast that I saw over in the West Coast a couple of years back. So if the economy doesn't turn around, and if we don't start seeing things beginning to move more positively, my expectation is that defaults, which are rising, will continue to rise. But it takes a long time, 2 or 3 years between stress and default. So this is one to watch, I think.
Yeah. Next up here, we've got GDP. We have touched on this a fair bit in previous episodes and already a little bit today. But anything else you want to add to that, Martin?
Well, just simply to say, iron ore, 120 US dollars, now 90 or just below 90 US dollars, right? The next month's data showed that the trade surplus was there, but not as big. If the US rate changes for the iron ore, as we think it will, this is going to have a drag on the GDP ahead. And I think it's artificially high at the moment. It's going to slide back. And China, of course, is also under question as to whether they're going to take more demand, as we've discussed before.
Yeah, I think the one thing I would add is that, well done, the government got their surplus. That's fantastic. But there's no point doing that if the real economy is breaking down. And what they've signalled is they're not willing to spend more. They're spending record amounts. And if they do get into a situation where they have to spend more, it takes a long time to get these infrastructure projects through the pipeline, even a year or 2 or more. So it's not like something they can just turn on and fix the economy overnight.
No, you're right. And, the discussion about helicopter money, in other words, handing real money back to real households, I think has got to be a live discussion, because if you just go through the infrastructure investment route, that's 2 to 5 years before you start see it coming through. We haven't got that time. So there is, I think, a building case for changes to New Start or some other mechanism to be able to put more money in the hands of real households. The question, of course, is how do you pay for it? Do you pay for it just by printing more money, which inflates assets, as we discussed earlier, or do you do it by cutting back elsewhere? And that's the conversation that the government does not want to have.
And if Australia got into the situation where they were running a surplus, but they were relying on the central bank to start QE and print money, that would be the first country in history to start printing money when the government's running a surplus.
Pretty much. And remember that if you go back a decade, right, pre-GFC, we had a very strong surplus. We had very significantly higher interest rates, so they could cut rates 4 or 5%. And households have been growing their incomes quite strongly in the early 2000s. So we were well positioned and prepared for the GFC. Now, if we get another global crunch, hope it doesn't happen, but it could, we are so ill prepared that it's just not true.
Yeah. Okay, so next up here, we've got that unbalance in the economy between the public and household sector that we've touched on, and Carmageddon, Martin, we keep reading about spending on vehicles declining.
Well, that's right. And I just want to highlight, the public spending is remarkably high. It's higher than it's been for a long, long time. Yeah. Household spending is remarkably low. That's the sort of bifurcation that we're seeing, as we've discussed. Yeah. But I think that the car sector is a real leading indicator of what's going on. And my surveys tell me that more and more traders are saying, shit, I can't I can't afford to buy a new ute now. And so the number of new vehicles purchased, leading indicator of trouble ahead, I think.
Yeah, and I think this plays into the whole notion that we talk about these big social changes where we've borrowed a lot from the future, and now we're to that level of debt where we can't keep borrowing, we can't grow at least. Maybe we can go sideways, but that affects the credit impulse that we talk about. And people are having to pay down all this stuff and they're tapped out. They're not going to be buying new cars.
Well, that's right. And remember that I always say, remember that there are two elements to a debt. One is the interest you pay on it. The other is the capital repayment, right? You still have to pay the capital back at some point in some way. And so if you've got big debts, even if interest rates are really low, it's still a burden. And that's now what many people are finding.
Yeah, and a car is very different to a house. If you get into a sticky situation, even if your house is down 10 or 20%, maybe it's gone up in some suburbs, that's okay. If you have to sell 10 cars at a business, when they're 2 or 3 years old, they've depreciated 50%. That's puts you in a bad situation.
Yeah, that's right. As you drive a new car out the showroom, you've lost 30% before you go anywhere, pretty much. So it's pretty scary. By the way, you can also lose as much on high rise. You buy a new high rise, you can drop 30% straight away as well. So just buying new assets, not always smart.
Yeah. So house prices up in some suburbs, and this is what we spoke about with on the media. We're seeing even day-to-day moving averages sort of talked about. But what do you see, Martin?
Yeah, so I think there's three things to say. The first is, the indices are definitely pointing up, and we know that in some places that's true. Question, of course, is how accurate are those indices based on very, very low transaction volumes and distorted reporting of the auction clearance rates, which remain quite high, but on remarkably low volumes. We also know that there's a very strong spike in new listings coming on now, and my surveys show me that. So I would expect to see more supply coming on. That may have an impact ahead. And thirdly, if you look at the spread of movements, it's not uniform. So we know that in some areas of Sydney and Melbourne now there have been significant moves up, not so in some other places. And the charts here from CoreLogic just make the point. It's at the top end perhaps that's moving quite slightly faster, but the top end was way down. The second is that if you look over the 12 months, prices are still down. And if you look at, in some areas, places like Hobart and Darwin, very strongly down. So this is not a universally good story, but I think what's happening is that there are a lot of people who've decided to go and buy now because they can see the price of houses, particularly in the inner suburb areas of Sydney and Melbourne, down 10, 15%. So a lot of people are buying older doer-uppers with the view to buying and effectively developing for themselves or maybe a small developer, because they're avoiding the high-rise sector like the plague. And so there's a real migration going on at the moment between the high-rise and investors in the high-rise sector who are predominantly wanting to sell and try and get out, and we'll see more of those being listed in the months ahead, I think. Whereas if you've got a small inner suburban shack or small place that perhaps needs some renovations, those are the ones that are really going through the roof, and that's where a lot of the upside on the value is at the moment. And that's why it's important not to talk averages but to get granular and to understand some of the differences in particular postcodes.
And we should start to see that spring sales volume ramp up in the next couple of months, and that's what's going to be interesting to see if the buyers are there to match that increased selling demand.
Well, there's definitely listing. We know the listings are going up. The question is, what does that do? Are we going to see more people coming and buying, or are we going to see people being a bit more cautious? I still think there's a risk that this is a bull trap. In other words, prices are up a little bit, so people buy into that rising market thinking it's going to go on rising. I think there are a number of suggestions that I see in my data to suggest it's probably going to go up a bit, go sideways, but could then fall through 2020 as some of the global things come through. But, that's just one of my scenarios.
Yeah, I think the scenario that I'm looking at most likely now is that if the central bank cut rates and do everything they've done in the US, then the Australian stock market and the housing market might make record highs, but it's in that upside down world. It's not for the right reasons. So that doesn't make it any more affordable for the average guy that's not getting wage increases.
That's exactly right. And going back to mortgage stress, going back to that issue of affordability, we've still got massive issues.
Yeah. Okay, so getting towards the end now, Martin, we've got units versus houses, and you've touched on this a fair bit. Avoid units like the plague.
Well, yeah, just to make the point, you can look at Miranda right in the middle of the page there, right? And basically you can see some differences between units and houses in terms of movement. So both down, but units more. We know that in some locations, units are down 32, 33, 35% now from where they were just a year ago. And this is all to do with the poor quality construction, the risks in terms of things like flammable cladding and mold and all those things. And there are thousands and thousands of buildings that are being hit now. This is probably one of the biggest issues that I see hitting the potentially economy over the next year, 18 months. I did a thing with the ABC this week, and I said, if you take the potential loss in value that we're seeing and the cost of remediation, which can be billions of dollars per high rise, or 80,000 per unit, this could be $1 trillion, pain. And the question is, who pays? Is it the government? Individuals, developers, whichever way you look at it, this is going to be a big drag on the economy.
Yeah, I've got a video coming out this week I think you're going to love, Martin. It's with a construction expert, and one of the things they're doing is talking about everything that's going on, and we're hearing rumours of people trying to cover it up because they're telling people that it will affect their sales price and the value. But they've actually got a project that uses blockchain that shows all the building materials and traces them and tracks them. So they're trying to solve this problem, but they're talking about how bad the problem is.
Yeah, and there are lots of people in my surveys who say, I've got cracks in my unit or in the building I'm in. I'm not sure I want to raise that, because if I do, and if it's serious, I could lose $100,000, $200,000 off the value of my property before I start. So there are a lot of people in what I call a prisoner's dilemma at the moment, right? Do they just sort of sit stum and hope that it's not serious, or do they actually start raising it? And the point I've got is, if you don't raise it and it is serious, the consequences down the track could be dramatic. But if you do raise it, you could be losing value and you could be up for big bickies. So whichever way you look at it, it's a real problem.
Yeah, and I know people say that maybe we're a bit doom and gloom sometimes, but if you're a real family, a young couple, and you've been told you have to get on the property ladder and you've bought an apartment, and here you are staring at $100,000, $200,000 loss, like that's just ruining your whole life. So yeah, we want to protect those people, but if you're a good investor, maybe you know what you're doing as well.
Well, that's right. And look, I said to people, if you're going to buy a unit, buy an old one, 30, 40-year-old. They're well constructed and they've probably got reasonably good standards. But more modern ones, be really, really careful and ask a lot of questions if you were going to go into the market now.
Yeah. Okay, so credit impulse is one that I think is most important, because in the debt-based economy, we need debt to continue to expand.
That's right. And of course, we haven't got the flow data. That's coming out later on. But this is the RBA data, and it shows again that, the impulse is still weakening. And people are asking now, have we broken the link between the credit impulse and home prices? I don't think we have, because I think what's happening here, we're seeing more people paying back more debt. So in a time of uncertainty, people want to deleverage, right? People want to pay back loans, and that's what's going on at the moment. But it's quite interesting to watch the housing investment, very, very low still. Owner-occupied lending growing, business lending sliding, personal credit down 3.7%. These are significant falls. Without the credit impulse turning positive, it's not going to be sustainable to see home prices moving ahead, in my view, over the medium term.
I think one of the things that we predicted in a previous show was those tax rebates would go towards paying down credit card debt and other debt, and it has not flowed into the real economy like that hoped.
And that's exactly what people are doing. And, my surveys show me quite clearly people want to deleverage, pay down debts. And, the advice I have for them is, if you've got a credit card debt, pay that off first, because the interest rate on that is massive, absolutely massive. Get rid of it, because then your cash flow will look a whole lot better.
Yeah, we did a show about negative interest rates the other day, and how credit cards are still over 10% at a time when interest rates are 0% or negative everywhere.
Well, credit interest rates on some credit cards, debit interest rate is up to 20% still. I mean, it's remarkably high, absolutely remarkable.
Yeah. Okay, so last slide here is your probabilities, Martin.
Yeah, I just want to come back to this because, people sometimes say, Martin North, the guy who says it's going to drop 40 to 45%. Look, just to highlight, that's if we get a global recession, if in fact the US goes off. I'm still modeling that it could, and, a 35% probability of that potentially. But it's not the only scenario. So if the RBA is right, and if everything goes really, really well in Australia, and they do a bit of quantitative easing, and they cut interest rates a bit more, I still think there is a path to home prices slightly higher over the next 2 to 3 years. Not my central case, only giving it a 10% probability, right? Yeah. More likely, we're going to see a little bit of a rise, a bit of a plateauing, and then probably a fall next year as the global economy bubbles down. But my point is, the real question we have to answer now to understand what's happening locally is what's going to happen globally, right? If the global risks continue to expand, if the trade talks but go the wrong way again, and it goes on. If the Brexit thing unwinds, if China unwinds, any of those are sufficient to create a GFC 2.0. In which case, falls, definite falls. If we can avoid that, and if the central banks magically manage to bubble rates lower and keep the confidence in a reasonable place, this could go on for another 2 to 3 to 5 years. But remember what I said earlier on: we're not solving the fundamental issue, which is we've got massive amounts of debt locally, massive amounts of debt globally, and you can't continue to cut interest rates lower and lower, going negative interest rates. You can't just bank on the cash ban and all those things to try and solve the problem. There is a fundamental issue at the heart of central banking, which nobody wants to talk about, but which I think has to be spoken about, because what they're doing at the moment is not going to get us to a good place.
Yeah, and the final point I want to highlight is, as you said, there's debt everywhere, and that's denominated in US dollars. And because US have got interest rates higher, that US dollar is continuing to strengthen. And so everyone else continues to owe more and more money in their own nominal currency. And this is just killing every economy apart from the US. So the world's interconnected these days. The US is running huge deficits with everyone else. There's not a clear path out of this.
That's exactly right. And I think a few central bankers are beginning to wake up to the fact that, the classical approach to solving the problem, which is encouraging people to spend more, is not working. The question is, what are the alternative strategies that need to be thought about? And are there enough central bankers waking up to the fact that the strategy of the last 10 years has not worked? I think it's too soon to say that. But, the right conversation to have is, what are the alternatives?
Yeah, and anyone that went against the US dollar over the years hasn't ended well. But now we've got Bank of England, Mark Carney, coming out and saying we need a basket, a cryptocurrency like Libra or Bitcoin or something, because it's not fair the US dollar is the world reserve currency. Like, again, truth is stranger than fiction. I can't believe we're hearing these things.
Yeah, I think that Carney comment was remarkable, right? Because what they're finally realizing is that if you're coupled to the US dollar, you are completely stuck with what they're doing over in the US. And, Carney's view was there's a time to start disconnecting that. That's a really big call, but I think he's right.
Well, that's a fantastic episode. I really enjoyed that today, Martin. I hope you guys have at home, and thanks for joining us.
Good to talk to you. See you next time.
See you guys.